Kia ora, and welcome to this episode of Shared Lunch, where we briefly touch upon everyone's favourite subject, interest rates. As you may have heard, the Reserve Bank has decided to again hold the official cash rate at 5.5%. But why does this matter? Well, this is what sets the rates we all pay on our mortgages, loans, and what we receive on our deposits. My name's Leighton Roberts. I'm the co-founder and co-CEO at Sharesies, and to understand the impact of this, we're joined by Infometrics principal economist, Brad Olsen.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Hey Brad, thanks so much for joining us. You're in Geneva, but obviously news travels very fast. How are you going?
I'm well, thanks. It's pretty hot over here, but I think everyone back in New Zealand is pretty hot under the collar as to what's happening with interest rates. So a lot of interest, a lot of intrigue still going on about what the Reserve Bank thinks and, importantly, what they'll do and when.
Hey, well, look, the consensus from what we're reading so far seems, that there was going to be no change, and that's what's happened. But specifically, there was a lot of talk about with regards to inflation in this one, and when rates are going to be about to be cut. So what's your take from what they put out today?
Yeah, look, actually quite a flip-flop really from the Reserve Bank in their view. Remember back in May they were talking about how they considered increasing the official cash rate. Now they're talking and saying that they're confident that inflation will be back within the target band of 1 to 3% by the end of this year. They're talking about how, look, interest rates have to remain restrictive, but that'll be tempered over time depending on how inflation actually goes. So really they've gone from sort of talking about a hike 6 weeks ago to effectively opening the door to an interest rate cut. Now, it's not going to come immediately, but it does start to bend your ear a little bit towards maybe November this year is actually likely for the Reserve Bank. A little bit hard to understand how they got there, but I think this is probably the right flip-flop because all of the data we have been seeing recently is showing the economy slow down, showing less inflationary pressure. It should open that door, and I think the Reserve Bank has just put a little bit of a crack in that door and opened up the opportunity.
Yeah, it really is a flip. I think the assessment last time was more hawkish than expected, this time more dovish. For listeners, the hawks are normally asking for a more aggressive stance and wanting interest rates to increase normally, and then doves being the opposite, so looking for lower interest rates, which is very much the read of how this one's coming out. So you mentioned November. Would you say that's your pick at the moment as well?
Well, the question here really is that do we think the Reserve Bank is going to stick to its message? Because again, it's completely 180 in the last 6 weeks. Who knows what they'll come out with in 6 weeks' time? Again, gosh, they could be back up to a 50 basis point hike given how they sort of go between one or the other. Now, look, I don't think that's actually seriously what's going to happen. But I guess I'm a little bit worried that we seem to sort of be jumping at every single shadow of every data point that comes out. You look at the bank last time, they were looking at inflation that had come in at a headline level better, at a non-tradable level worse than they'd expected. You look, though, at sort of a week or so ago, you've got the latest quarterly survey of business opinion from NZIER. Looked a lot better in terms of inflationary pressures pulling back and similar. I guess I'd hate for inflation to come out next week and the bank to go, oh, well, all of a sudden it's worse and therefore we're back to our hawkish stance. So I just don't think I have enough confidence in the Reserve Bank's ability to get out of the same bed every morning at the moment to say what it is. Here's, I think, the frustration. Infometrics, we were at November 2024 being the first cut. If you go back a couple of months, after the last statement from the Reserve Bank where they were like, oh, geez, we need to hike it up, we actually pushed it out till February. Now, I'd hate for us to also flip-flop and go straight back to November, but I guess what we're sort of seeing is that we were pretty convinced that there's enough information that will come through by November to cut. We just didn't think the Reserve Bank would have that much gumption because of how strong their talk was. So between November and February, I think, is a very live possibility. I don't know if I'd put money either way on it because I don't know if the Reserve Bank is particularly consistent on their view. But given everything we've seen so far, given that weaker data coming through, it does seem to be consistent that if you can get inflation below 3% by the end of this year, that should open the doors for the Reserve Bank to go, yep, we're definitely on the right pathway. Now is the right time to ease because it's going to take a bit of time for any of their decisions to actually fully hit the economy.
Yeah, interesting. And there's a few changes still to flow from here. One of the things that the statement today will do, I'm sure, is swap rates will adjust over the next few days, and swap rates are where the mortgages are priced. And I do expect we might see a bit of home loan rate easing off the back of this. That will have an impact. And then, of course, we'll have the new changes from the government with tax relief coming in over the next month. So I very much agree there's a lot of movement still to happen. But if we just bring it back to sentiment in New Zealand at the moment, it feels like there's a bit of pain now, really in the households and businesses alike. And I think that's not so flip-floppy. I would say that's feeling reasonably embedded. So, what do you think? Have we had enough pain?
Oh, I think that you're right. I mean, that pain is quite clearly hitting now. You see that in all of the indicators. What is interesting is anecdotally going around the country, I've been hearing from a lot of people that sort of said, look, the first 3 months of 24 were hard, but not sort of, that they were manageably hard. But sort of from April on, it feels like things have gotten a lot darker. And I think, again, you're starting to see that through in a number of different indicators, which are effectively saying, look, I'm finding it tough as a business to just get sales. Households are finding it tough to find the money to go out and spend. And so all of that does imply, and you see in the business surveys, people saying, look, it's tougher at the moment to get that sort of economic activity. I'm not wanting to put up prices quite as much. People who are saying, look, I don't think that my job security is all that good anymore. Therefore, I'm probably not asking for pay rises like I might have been before. All of that, I think you're right, is consistent with that view that the hits come through, that inflation should fall back, that the Reserve Bank's got enough evidence. And I think probably the two things we're looking out for in the short term, you've got inflation data out next week, you've got labour market data out in a couple of weeks' time after that. If both of those continue to show that softening, and we expect they will, then I think that really does add that weight of evidence behind the Reserve Bank being confident and then acting confidently.
Yeah, interesting. The labour market has sort of been the saviour, hasn't it, with regards to the economic or the positive story out of a lot of these lately. But that data will be interesting because it feels like that is most likely turning. One of the interesting things, just as a point, is we've just done the investor survey that Sharesies does as well, our index, and investor sentiment has turned back to a balanced view, which one of the things that maybe is people expecting to see interest rates start to cut, and as interest rates change or go down, then people do look to other asset classes like equities. So it'll be interesting to see how that plays out. Anyway, what's your key takeaway from the MPS, the monetary policy statement? Was it an MPS? Actually, I don't think it was today, was it? But
no, it was just a monetary policy review.
So
look, I think the main message here, I think, is that, look, rates cuts are sort of more live, more on the table than before. It's going to be interesting to see how the Reserve Bank squares this up in a couple of weeks when they release their next actual monetary policy statement and their forecast. You remember, again, 6 weeks ago, they were picking, an increase and no real cut until August, September next year. If they're going to be realistic on the talk that we've just had today, they'd have to bring their pick forward like 10 months. That would be pretty substantial and would require some pretty serious explaining. But I think you're right that sort of this is a bit of a sentiment shift as well, in that people are feeling quite challenged at the moment, but also a feeling of some of those greener shoots maybe emerging next year. People have been taking out shorter and shorter home loans because they're expecting those interest rate cuts. You noted that sort of shift in sentiment from the Sharesies index. You're seeing, consumer confidence not good at the moment, but expectations for next year look better. It does seem to be that sort of still survive till 25 story, but maybe a slightly earlier pitch for that interest rate relief. It's not going to be huge, but it will make a difference when it comes, and the Reserve Bank seems more open to it now than certainly what they were 6 weeks ago.
Yeah, nice. Great, Brad. I've heard a bit of that survive to 25. Like I saw someone else write about thrive to 25 the other day, which I thought was a great mantra for us to carry forward. And certainly what I got out of my experience in the US a few weeks ago was people taking more of that view. But certainly a lot of complexity out there in the market still, and interest rates adding to that with regards to challenge. So I'm personally of the view that I'd like to see them drop sooner rather than later, but completely understand the pressures and wouldn't want to be sitting in that room making the decision myself. So one last question for you. What do you think the risks are of them having gone too far and it being harder to pull back into a growth cycle because of holding interest rates too long?
I think that sort of the longer we leave it, and certainly almost every passing day, it feels like that risk grows greater and greater. They almost have certainly overcooked it a touch. It's just, do they bring it back by moving by the end of this year, or do they sort of leave it that just that extra 3 months over summer, sort of starts the year off with a slower start? I think that might well be a mistake. Just not sure if they're sort of going to stick with that view that they held, if they're going to move sooner. I think they've opened the door, and so that might signal a bit of a shift. But like I say, we've been here before, we've seen these changes come through, and I'm never quite sure if I back it. I want to see a little bit more data and certainly a few more resounding words from the bank to really lock in that expectation.
Yeah. Do you think we'll be first to go? Like US haven't gone yet. Australia still talk of higher interest rates still. Do you think we'll be the first to start cutting?
I don't know if we'll be the first. I'd still expect probably the Fed will go in the next month or two, maybe 3 months. I do think, though, that Oz is a real life possibility of having to hike further. I mean, their inflation has actually been re-accelerating. At least we don't have that. Sure, ours isn't going down as fast as we might like, but at least it's not going up. So I think, definitely a different risk profile depending on where you are in the world.
Yeah. Hey, great. Thanks for joining us, Brad, in Geneva, 6 a.m. in the morning with a hot day ahead of you. Really appreciate it.
Thank you.
And thanks also to everyone for tuning in for this short episode of Shared Lunch. You can watch Shared Lunch on YouTube or wherever you get your podcasts.